Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, as always, a lot of news to get to, but first, we're coming up on Shred Day, Saturday, May 20th. Tell the folks what that's all about again.
Oh, absolutely. So, your identity theft is very real in the digital world we live in today. So, one of the ways identity thieves get your information is picking through your files, your garbage. People have all kinds of old boxes of statements and things in their garage or attic or in their home office, and they keep documents. My dad was guilty of this stuff for way too long. The IRS or the government will never ask you for documentation over 7 years in most cases. And so you need to shred any documents that are older than that. And so you have less risk of having those documents get, released somewhere you don't want them or end up in the, in the garbage somewhere, and someone goes picking through and gets your information. So you can shred credit card statement, anything with financial or sensitive information you should be shredding on a regular basis that you don't need and are not required to keep. So we offer this service every year where people can come by and shred their and we're offering it to the listeners this year. You can bring up to 2 full banker's boxes, kind of that file box size.
2 feet by 1 foot by 1 foot, roughly.
Yep. Complimentary, and we will have the shred truck right here on the premises where you can actually watch your documents get shredded. They got a little camera on the thing. We've been doing this for a lot of years, and it's complimentary, and we'll be doing that on Saturday, May 20th, 9 a.m. to 11 a.m., I believe. Is that sound right? Okay.
9 to 11 a.m. Saturday morning.
So we do want you to register, though, because we do have people. Sometimes we get a line form, so we just have to know if you're coming. So just give us a call. Let us know, 402-369-7777. Be happy to have you drop off your documents complimentary.
All right. On to the news, David. Another one bites the dust. And you had sent up a warning flare the last couple of weeks on this one. Here's the headline from Bloomberg. J.P. Morgan ends First Republic's turmoil after FDIC seizure. That's First Republic Bank. Now, David, you sent me this story, and you were a little cranky about the way this played out. Tell us why.
Well, again, my humble opinion sometimes is, I can't give you all the data and facts behind it, but basically this was what amounts to, and it's not just me. There's a lot of people out there in our industry that are talking about this. Seems like it was almost a rigged bidding system. So what happens when a bank goes into receivership, people put in bids to basically the FDIC to take over the assets of that bank, right? And they're willing to come in and help and take them over. And of course, why would you offer to do that, Chip? First off, right? You would not do this to lose money, right?
No, ultimately you hope to make out on the deal.
So you're willing to take over, and why does the bank fail? So we need to start with that real quick. Usually, and this was the case with the big one, SVB, about a month and a half ago, right? Silicon Valley Bank, we talked a lot about, is they bought a lot of long-term debt obligations, fixed income bonds that had long date maturity, and because the interest rates have moved the way they have in the last year, those bonds are underwater if you were to sell them today. Some of them as much as 40 to 50% in the current value. But if you hold them to maturity, if you have the wherewithal to hold them, you're willing to wait, and they'll come back to par value, right? So they'll accrete back to their actual price. So if you could buy them at a discount today and then get that accretion, not only do you get the value, but you can actually buy them at a discount from basically the FDIC, you're going to make a profit. And what really got me upset about this is the taxpayer is the one paying for a lot of this. And I actually got in a little bit of a spat on Twitter with a talking head on CNBC earlier this week on this very issue. He's trying, that's not how it works. I was like, and this is somebody. He does
CNBC is supposed to be that should be an expert.
Yeah, well, this person, his degree, he was a gym teacher, and now he's a talking head on. Okay,
yikes!
Yes, he has an education degree in physical education, and now he's supposed to be this financial expert, as you say. And I don't want to bash who it is, but he's somebody that's been on there for a while, and he's like, I don't think you understand. I was like, I don't think you, and so I sent him all the data. But J.P. Morgan, by their own admission, and then the article came out, and he didn't believe me. J.P. Morgan said it Monday morning that they are going to profit. They expect to profit an immediate profit of $2.6 billion from this deal.
Is this like just here's a bonus for stepping into the breach?
Free money, right?
Yeah.
And they're adding almost $500 billion of assets to the balance sheet for them, which makes them, they're already the largest. And I joked about it at the team meeting. I don't know if you picked that one up, but I said, somebody's like, well, what does this mean? I said, well, it means in 2 years, there'll be 2 banks. There'll be the central bank, right, the Federal Reserve, and there'll be J.P. Morgan Chase, their boss, right? Now, of course, I'm joking here, but unfortunately, yes, this means we're going to see more fail. And what we're talking about, folks, is First Republic, which failed over the weekend. But immediately, the crisis is over. That was his
That's
comment.
Jamie Dimon
Yeah,
from J.P.
yes.
Morgan Chase.
Oh, the crisis is over. And Janet Yellen put some rhetoric out there. It's all good. And then 2 days later, what did we see? We saw Pac West drop over 35%, their stock price. We saw Western Alliance, more regional banks. So the carnage is not done, folks. There are going to be more failures, and it's going to spread because we talked about, there is a run on banks right now. We have clients calling. I just had my own nephew who runs a construction company in Central Florida, and he has to keep about $2 million in his operating account to pay payroll and vendor, his subcontractors, et cetera. He's like, how can I guarantee this? And so I believe what you're going to see, and maybe this is rightly what should happen, is maybe there should be FDI insurance for business accounts at a higher dollar amount. And I don't necessarily think that dollar amount has to be a set number like 500,000 or $1 million. Maybe it's a business can prove their operating expenses are X and they guarantee them up to 6 months, because it would be prudent for me. I keep 7 figures in the operating account of our company. I have to pay payroll, pay rent, all the expenses we have. But, you want to put confidence back in small businesses in America. And right now they are running for the hills. And we talk about, we do treasury management here. And every day we're getting phone calls from clients transferring dollars in that we're just putting in basically T-bills, mid-range T-bills, to get them a guaranteed interest rate with no state income tax, by the way, and no risk of a bank failure, because people are nervous, Chip.
Well, did you just say, though, that the dominoes have not stopped falling?
That is correct.
Okay.
And we
contrary to the official narrative being put out there.
Absolutely.
All right. I just want to clarify that.
Well, let's look at history here too. During the 08-09 crisis, right? The Great Depression, as we called it, right? Or Great Recession, excuse me.
Yeah.
Great Recession. We had over 150 banks fail. We've only had 5 so far. Okay. This round. We had 100. But here's the scary part, Chip. Double the assets in the 5 banks that all 150 banks held collectively 15 years ago when they failed.
Ooh, wow.
Now, on top of that, Chip, we have the fastest retraction of M2 money supply since 1930. The Great Depression.
You did mention that.
Okay?
You did mention
so
that.
So when the money supply shrinks, there's less money available for deposits in banks. If they get less deposits, they have less ability to loan, which is where the economic engine gets fired up, right? So small businesses, there's going to be somebody that can't open up that pizza shop or the hair salon.
Don't have enough fuel for that engine.
Exactly. Yeah. And so we are on the precipice of an incredibly nasty slowdown. Yet Wall Street keeps on pushing it. Everything's fine. Yeah, greatest, no problem. We still have inflation. The Fed doesn't know what to do. They're stuck in a rock and a hard place, and we're having banks fail. And so bottom line, you need to be prepared. We're not trying to scare people. We just need people to understand you need to have a plan of action. I got to sit in a couple of client reviews this past week, and one of the client's statement to me was like, I'm so grateful that we have somebody who's proactive, and we don't expect you to be perfect, nor do we promise to be, right? But being proactive is better than just kind of putting your hands under your, sitting on your hands, so to speak, or, putting your head under the pillow. You've got to have a plan of action. So no matter what the economy brings us, what type of recession ultimately unfolds before us, your finances, your portfolio, your retirement, your planning has a course of action already predetermined that you will take based on the data as it unfolds.
We have strategies to address various scenarios, but you must engage. You got to work it. Hey, David, before we leave this topic, I got to go back to one other thing. You referenced the taxpayers, and you talked about a dispute with somebody at CNBC. What exactly was the dispute, and why are you concerned about the fate of the taxpayer in all of this?
Well, so the Federal Reserve is a private agency, right? Contracted by the government to operate.
It's the government, but it's not.
It's not.
Yeah.
So they went from a stringent reserve balance sheet model where the banks would pay them interest to an abundancy model where they now pay banks to put money in the Federal Reserve. So they pay you to put money there. They are losing over $500 million a month in interest payments at the current rate of interest. Where are they getting the money? They're a private entity. How are they making payroll? How are they keeping the lights on? The Federal Reserve.
The Fed, yeah.
Yeah.
Okay.
How are they keeping the lights on over there? No one is asking this question. Brian Westbury is one of my favorite economists at First Trust Portfolios, is trying to get someone he's begged Steve Leisman, who is a CNBC personality, who is the representative that is the liaison to the Fed for that news channel. And he is, we're trying to get him to ask these questions. I've sent him messages. No one will get them to answer that question. How are they keeping the lights on? If they're a private entity, Chip, where's the money coming from?
Well, they can't tax, so
the money's coming from the government somehow, some way, and I can't tell you where or how it's happening, but you, the taxpayer, are footing that bill. period. So it to 14 billion so far on this deal, new money.
Somehow you're saying somehow the federal government is backstopping it, and that means you, the taxpayer.
Correct.
But even you are saying right now, it's a smoke and mirrors game. You don't know the answer to the question because no one's disclosing it.
Correct. They're not disclosing how they're even having any cash flow to
That's-
operate, and of course Ron Paul for
That
years
is
audit the Fed, audit the
supremely
Fed.
aggravating.
Absolutely, it is. And again, Brian Westbury has plenty of this stuff out there. You can Google his name and find the research on this. And they need to answer these questions because when something is this hidden for this long and it's this bad, it doesn't end well usually, right? So we just want people to be prepared.
David, just quickly here before we finish the segment, townhall.com, the first quarter GDP report is a disaster. I guess the prediction was for 2% growth of GDP. It was barely half of that at 1.1%.
Absolutely, and you can go on the different the Federal Reserve. We have these different banks around the country, right, and the voting members, et cetera. The Atlanta Fed, it has what's called GDP Now on their website, and they're usually a good leading indicator. The day before the number came out, the day before they changed their estimate for the first quarter from 3.4 to 1.4. They changed that less than 24 hours before the real number came out. I mean, that is, you talk about smoke and mirrors, and we think that you're going to actually have the NBER, the National Economic Bureau, is actually going to call a recession that started in January this year, even though we're showing 1.1, because we think you're going to see a turn drastically in the employment numbers, et cetera. We talked about this last week coming, but yeah, it was a disaster. We are slowing down, and M2 money supply is primarily why.
Okay, but as David said a couple of moments ago, don't panic. You need to be aware of the facts, but don't panic. Come see us, 402-369-7777. Get that complimentary report card. We'll review your entire financial situation. Maybe you're in good shape. Maybe you need to make a few changes. Now is the time to find out. 402-369-7777 for a complimentary report card. Up next, David Brooks is great, but it takes a team to do what we do at Retire Smart. We welcome back to our show a vital member of that team, financial advisor Mike Schudel. Next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our special guest this week is an experienced financial advisor who also is an attorney, a certified financial planner, and he has taught finance classes at Creighton University. He's our go-to guy on estate planning, and we're glad to have him back for another visit. David, please introduce our special guest.
Hey, yeah, thank you, Chip. Yes, once again, we have our in-house estate planning kind of lead, if you will, from all of our financial advisors in our saddle here, Mike Schudel, who also happens to have a law degree amongst a lot of other letters behind his name. Mike, hey, listen, thank you for taking time to jump on the show this week.
Thank you very much for having me.
Absolutely. So last week we had Colin Kastrick, who you partner with to teach the estate planning class at our Midwest Learning Center, which is coming up next week, and we'll give you the details on that here in a little bit, folks. But Mike, I really wanted to talk about I was talking earlier with Chip on the show. Obviously the economic data we've been talking about for a while is not real rosy out there. But when it comes to estate planning, sometimes when the economy is in a downturn, this can be the ultimate gift to your gifting or estate planning strategies, right?
Absolutely. We are anticipating some tectonic shifts in where the estate tax exemption is going to go to. Right now, anybody in America can give away $12.92 million of their assets, both while they are alive or after they are gone, if they do it correctly in a well-defined estate
And that is
plan.
a tax-free gift. A lot of people
Yes.
misunderstand that. You think,
Yes.
I can only give 17 grand away. No, that's without using any of the exemption you're talking
Absolutely.
about, right?
Absolutely. Well, we anticipate in 2026 that's going to go down. It is yet unclear where that's going to land at, but it could be anywhere from half to a third of where it is today.
And under the current rules of the tax code that is written, it's going to go back from the 12.9 to 5 million with an
Yes.
inflation adjustment, which we believe is somewhere about 5.8, 5.9 million. Right?
Absolutely. But all the articles I'm reading, it sounds like that number is going to certainly be talked about on Capitol Hill. It's not
Absolutely.
just going to land there and be like, yep, 5 million's a number and now we're done.
Well, when we talk about it, this is the area that the conservative side of our legislators, of the legislative body, typically give in on because it doesn't affect that many constituents, right? So
Absolutely.
they can kind of use that as a bargaining chip, and they don't hold very strong. Even though I don't believe we should have what we call effectively a death tax, personally. I think you work your whole life, you're able to pass your assets on to your family, your charities, whoever you want. But that's not what the rules of the game say. So basically, a married couple. Now, this is really important. You don't automatically both get this exemption.
Mm-mm.
You have to actually take advantage of it when we lose a spouse. You can put the assets aside when we lose the first spouse in a married couple. So basically, you can almost give away $26 million
True.
today. And that seems like a whale of a number for a lot of people. But we have a lot of families here that own farmland that's been in there for generations, right?
Absolutely. Yep.
And what if you just been blessed to have some stock, or you were an early investor in companies like Berkshire Hathaway, and you've amounted this massive amount of wealth on paper? It's nothing you plan on selling. Do you understand, if you don't take action and plan today, what the tax ramifications could be when you try to pass those assets on just 5 years from now, 10 years from now, whatever?
Absolutely. Well, let's talk a little bit about that. When the market goes down, that's very stressful. Nobody likes to see that. But if your assets have come down in value, folks, the market has never gone down in human history without at some point in the future, it might be a long time away, but without at least recovering and then some. So if we know that this is market cycles, as painful as they can sometimes be, don't just sit there and complain about how much it hurts. Take advantage of maybe shifting some of the assets that are in your name that were at one point very highly appreciated and would have been very expensive to cash in on yourself, and shift that to the next generation.
And that just comes through accurate and adequate estate planning, which is what you and Colin are going to cover next week in the class, right?
Yes, indeed. And let me just land with one other point. I understand how huge a number 12.92 million sounds. And as you point out, David, with a correctly built estate plan, you must do this purposefully. You can double that number. We don't know if it's going to land at $5 million per person for sure, but there's even whispers. Bernie Sanders said that if he would have won the presidential election back in our last election, he would have taken that number down to 1 million.
And that's still what several of the far left in Congress want to
Yes.
do.
And that includes, at your death, every asset you own, everything. And if it gets over $1 million as per his wishes, the current tax burden is 45%. So I am guessing that most of the people in our audience, if you added up every asset that you have and that you will probably pass away with, it's most certainly around $1 million, I'm guessing.
Well, what's key to, so when I started in this industry 24 years ago, it was 625,000. That was the exemptable number, and the average client didn't hit it. So
Right.
So we're talking 2.5 decades ago. It seems so small today, right? But a client would come in then. An average client would walk in with $200,000 in investable assets.
Yep.
But they would own a home that was worth maybe $150,000 at the time. That would be like a $500,000 house today. And then they would have life insurance. And this
There's
is the
the
area that
one.
people, oh, that counts.
Yes.
Yep. So if you own your life insurance, the death benefit from the carrier will pass tax-free to the beneficiary. However, that a dollar amount, like if you have $1 million life insurance policy, that $1 million counts towards the estate tax exemption of what
Yes.
the assets you're allowed to pass. Therefore, you could give up 45% of what you thought was a tax-free asset to your kids or beneficiaries or grandkids, whoever you're going to leave it to, which is why I always tell people you don't want to own your life insurance. Yet over 99% of all life insurance policies in America are owned by the insured, right?
Yes.
Most people own our own life insurance, right? And they're thinking, well, of course I own it. Well, you're going to cover one of the strategies where you can simply park that outside of your estate, doesn't give away any of the estate or gift taxing exemptions. You can just slide this over into another vehicle, and then you won't have that problem. But you just have to do the
Absolutely.
legwork, right?
Yes, you do. You must engage with a professional.
So let's talk about a little bit in the class how you kind of walk through from the most basic estate plan and why everyone, in our humble opinion, needs to have an estate plan from the most basic estate. So you talk about how to leave instructions behind, right? And then for the more complicated cases where trust work and things like that can come in.
I'm so glad you said that, David, because a lot of times we do get kind of focused on, well, what's going to happen to the really big clients and their financial situation. Folks, these are educational workshops that we put on here at Retire Smart. They're designed for everybody who's got a very simple situation all the way up to the multimillionaires. So if you are free and available to come to our class, we would love to host you. I'm going to cover the basic things with Colin Kastrick, a practicing attorney. from the most basic stuff that you want to be aware of and probably have in place, all the ways to some of the more sophisticated planning tools that David outlined.
So this class is coming up, I believe, next week, May 10th or May 11th. So there's two opportunities for you to attend at 6:30 p.m. right here at the Midwest Learning Center, right across from Boys Town, exit 137 off of Dodge Expressway. So when you're talking about the most basic, and this is the stuff that a lot of clients, well, I don't really need an estate plan when they have, they've saved $400,000 or something for retirement. They have their house, and so they I don't really have a big estate. Well, you still need to have your documents in order, your instructions in order, because first we have to talk about how to, if you're married, how to pass assets from spouse A to spouse B in the most efficient manner. And there's mistakes made there all the time, especially with IRAs. There's rules. If your ages are different, you need to understand when you would want to make it a beneficiary IRA versus a spousal IRA. There's all kinds of nuances to the planning process that if you do it in the wrong order, you kind of lock yourself in, and then you end up, usually having mistakes. And we see this from other financial firms when we're looking at something. Oh, I inherited this IRA 2 years ago from my dad, and they told me I didn't have to take an RMD. Well, that's not true. If you inherited an IRA from your parents, just after 2020, the stretch IRA has been eliminated, right? So we used to be able to do what we call stretch out that IRA over your life expectancy when you inherit an IRA from mom or dad. That is gone. So there are strategies we can show you how to mitigate or reduce significantly the tax burden from inheriting those, what we call qualified assets, 401ks, IRAs from mom or dad, et cetera. But if you don't put the order of operations right, as you're so good at putting out, it could be disastrous, right?
It really could. And so don't let all this intimidate you. We will talk about some basic techniques and verbiage. If you just have the lingo, you already have a lot of comfortability. And then whenever you're ready, take the next step with an attorney of your choosing, or we would love to set you up with a meeting with Colin Castrick so that having that initial conversation, it's going to reduce so much stress. You'll understand what is the right plan for you, and then you can move forward in confidence.
So one of the things that you guys are going to cover too is what we call the basic estate documents you need. You need a will, which is just a letter of instruction, right?
Yep.
But then you need what I call HIPAA releases, right? This
Power
is
of attorneys.
Yeah.
Yes.
So you've got basically, like, my kids carry these laminated cards that is HIPAA releases, basically because they're adults. So if they were in the hospital, it's already in their wallet that the hospital can give me, my wife, even their grandparents information, and release it, because they won't be able to do this. So little things like that are really in the entire package. And exactly, you've got powers of attorney for financial or health related, right?
Correct.
And you don't have to have the same person as the person you assign for those, right? So you may have one child you want to make medical decisions. And we talked about this last year. My mom's husband passed away, and I am one of the power of attorneys for the financial decisions. My sister, who has nothing to do with the finance side, is the power of attorney for the medical decisions for my mom. So we have different siblings that are in different, have different responsibilities. And with your kids, if you have multiple kids, you can set that up. But you guys talk completely about how to set all this up at the class, right?
Yes, indeed. Absolutely. It's not as intimidating as it initially might sound.
Very good. All right. So listen, unfortunately, we've run out of time already for this week's segment. So this class, again, is going to be Wednesday, May 10th, or Thursday, May 11th. At 6:30 p.m. This is one of our most popular classes. This and the Social Security class are the two most popular by far, and we have a full house. Last time you guys, I think we had standing room only.
It was.
And so if you want to get registered, give us a call now, 402-369-7777, and we'll look forward to seeing you next week. Mike, thank you so much for stopping by this week.
Absolutely, David.
All right, Chip, what do we have up next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about a continuing theme on the show, blue versus red. Here's the question. I heard you guys talking about New York versus Florida by the numbers. Oh, that was that Wall Street Journal article.
Yeah, there was a lot of great data in there. There really was.
So the question is, I saw an article about blue states versus red states in general, and how people are voting with their feet. Nebraska is not as bad as New York or California, but as I approach retirement, should I be looking at Texas or Florida? What do you think, David?
So first off, you are correct. Nebraska is nowhere near as like a California or New York. We are about 35th or so out of 50 states in tax regulation, and the average taxpayer here is a couple $100 below the medium, right? So the average taxpayer in America pays $5,400, a little worse than that for us here in Nebraska, and that's all taxation. So sales tax, property tax, income tax, and then registration and fees, things like that for your car and all that kind of. I mean, like I complain, I have to give Sarpy County, I don't know, whatever, it's $25 for my dog, right? I mean,
Yes,
they
too.
lose money on this deal. That's the funny thing. They think it's a revenue. Who do they pay salary, benefits, and all this to administer this program, punch in the data to collect $18 or $20 or whatever it is a year? It's an absolute lunacy the way governments think that this is revenue. No, you're costing yourself because you don't need the employee to. But anyway, sorry, get me off. So the question is, should you consider moving? Now, from a purely tax standpoint, you absolutely should at least consider if that's something that is amicable for you to do. In other words, some people want to stay right here. If their kids and grandkids are here, they don't want to retire. It's a great place to live. Maybe you want to be what we call a snowbird and go part of the time somewhere else. But if you were truly looking at relocating, it's not just the tax burden chip we look at. And we will show the tax, but healthcare, the second biggest expense for the average retiree, is a big factor as well. And we're in a great state for healthcare costs. The second cheapest by the latest research. So if you were to move to Florida, let me give you an example. We had a client ask us just that. They were going to move down to an area just north of Fort Lauderdale, Florida, okay? Port St. Lucie, it's called. It's an up-and-coming area, kind of south of Melbourne and Vero Beach area on the East Coast that is growing, and so it's more affordable than most of Florida relative. It's still, not cheap. But they were looking at going there because, of course, no income tax, right? And the property taxes are more favorable, at least percentage-wise. However, when I showed them what the healthcare change was, it was about $7,000 more a year in healthcare there than here.
$7,000
And
more.
they were going to save about $4,000 in taxes. So it was a net $3,000
You're gonna
loss
lose on that deal,
right
yeah.
now. Better weather, all this. But what
Yeah.
we want you to do as a holistic financial planner, somebody who is a fiduciary, our obligation is to tell you what we think is in your best interest. And so we just want to lay out all the facts, not just pick a fact, if you will, and make it. So that's why tax planning is so important to us here in our smart proprietary planning process, Chip. If we can show you how to mitigate those taxes and stay right here and still get the cheaper healthcare, sometimes, hey, you end up what do we call winner chicken dinner, right? So that can benefit you. But ultimately, before you make a big life decision like that, you need to get the data. You need to have someone run the analysis. And that's what true holistic financial planning is. We're going to cover all those factors that matter for a retirement plan, not just taxation, not just your risk management, not just your income plan, we're going to include legacy planning. We're going to include asset transfers or sales. We're going to include the medical and healthcare that gets skipped by most financial professionals. So again, we'll show you the numbers, but yes, from a taxation standpoint, you absolutely should at least consider what it looks like. And by the way, all of our bordering states are better for retirees from a taxation standpoint than the state of Nebraska. Hello, legislature, wake up. So,
Yeah.
but you need to know the whole story. Okay.
I did not realize. I've always known that we have excellent health care in Nebraska. I did not realize what you just said. The second cheapest doesn't sound right. The second most affordable system of healthcare in the nation in Nebraska.
And a lot of this is based on what's called the outcomes of our local facilities, or mainly our hospitals, right?
Yeah.
How well they treat people. Do people get readmitted for the same disease states, things like that?
Okay.
And more crowded areas, unfortunately, suffer sometimes because they just can't keep up with the volume people walking in the door. And of course, South Florida is one such place. So
Yeah.
a Medicare policy, just give you an example, a Medicare policy for a female turning 65 that bought a private, what's called Plan G, through one of the national carriers. I'm not going to bash the carrier, but here that plan was like $132 this year. In Miami, that plan was $395. The same plan. Same plan. Exact same plan. Same coverage, same benefits, everything.
Roughly twice as much.
So people ask why. Well, it's based on basically your zip code because of the reimbursement rates, what they have to pay the hospital, and how well the hospital grades out. There's a lot of factors go into this, but so it's incredibly important, again, that you look at all the factors of a true financial plan. There's 5 key areas, according to the Certified Financial Planning Board, that are addressed, and that's what our smart planning process addresses.
Well, the M in a smart plan is for medical and health expenses, and I've heard you say numerous times that comes right after taxes as your largest expense in retirement. I didn't know we had that kind of an asset working in our favor.
We do.
Nebraska. That's good to know. All right, David, the next question is about Apple savings accounts. And the question's very simple. Did I hear it right? is Apple now offering banking services?
You betcha. And they collected $1 billion, Chip, in 4 days when they announced their savings account.
Deposits, you mean?
Yes.
Oh, my goodness.
They announced basically their version of a high-yield savings account.
Okay.
I believe the rate was like 4.05 or 4.15%. Great
That's
great
pretty
initial-
healthy. That's
Yeah.
pretty robust
Yeah,
rate.
that's better than the national average, and over $1 billion flow. And I got a couple text messages from family members, hey, should I consider this? So let's talk about what happens when you give a company your money. So in the brokerage world, we are not a broker. Okay. I started my career at brokerage facilities. There's a word we had to explain to people during the dot-com collapse in 08, et cetera, called rehypothecation.
Rehypothecation.
Fun word to say, rehypothecation. Rehypothecation is when you own stock at a brokerage firm. Again, we are not a brokerage firm. We're what's called a registered investment advisor. We do not rehypothecate. But here's what happens. Let's say you're at a brokerage firm, that is a broker. And so these are people that charge you for transactions, et cetera. When you buy stock, they hold it in what's called street name, right? So they own the stock. It's just held in, it's segregated. That stock is yours, Chip, right? But it's actually held in the company name or what's called street name for Wall Street. They are allowed to rehypothecate those stocks to do anything they want with them. In other words, they can loan those stocks to someone else who might want to short the market or what have you. So they use the asset as leverage. The reason I'm pointing this out is banks and savings companies that want to create these savings accounts, as Apple's done creating its own bank, what do you think they're going to do with the cash? They're not just
They're not just going to sit
it's
on
not
it.
sitting in that big circle building out there in
They're
California.
going to put it to work.
They take this cash and go put it to work. So are you confident? Now, look, they're basically the largest company out there, so maybe you are. But are you confident enough that that's where you would park your life savings if something were to happen with the tech industry and they were not able to facilitate and give you your deposits back or something like that? I'm just, obviously they've got to have the regulation and everything set up.
I was just going to ask, what are the restrictions on what Apple can do with that pile of cash?
Well, just like any other bank, right? They've created a bank. They're going to have reserves, but they're going to take those dollars and reinvest them. So is that what you want? Is that what you want to support with your dollars? So all we're saying is just think it through before you give somebody who's brand new to the banking industry your life savings, even for a teaser rate. Because I will tell you, again, through treasury management with clients, I had this discussion yesterday with someone, is we can get you that type of yield on U.S. T-bills right now, and you don't have to pay state income tax on that, where you would on the savings number. So your yield actually could be even higher potentially.
Rehypothecation. You get 3 credit hours for listening this weekend, friends. David, let's see if we can squeeze in one more question. Oh, I love this because I remember the first time I heard you explain this. Anyway, it's about life insurance. And the question is, I was in a conversation with friends and life insurance came up. I repeated what I've heard you say. A person should not own his or her life insurance policy. Of course, they were intrigued and asked why. I couldn't remember why. Would you please remind us why we should not own our life insurance policies?
Now, we don't set this up, but what a coincidence. We literally just talked about this the last segment. We had Mike Schudel on the show for the estate planning class. So life insurance proceeds, again, when you buy life insurance, now over 99% of all policies are owned by the insured. That's typically the way it is. You're like, when you're younger, you typically buy at least a term policy to cover, the mortgage or what have you. If, gosh forbid, you still had debt and you wanted to make care your wife or kids are taken care of, et cetera. So when you buy the life insurance, Chip, the death benefit is always going to be dispersed tax-free to the beneficiary, but the death benefit is calculated as part of your estate for estate taxes, and in some states for inheritance taxes. In Nebraska, we do have an inheritance tax.
You want to find a way to get it out of your
right.
estate.
So a simple tool that you can use is to set up what's called an ILIT, I-L-I-T, an irrevocable life insurance trust. It's just a piece of paper that you transfer ownership over to your life insurance policy. You still make the premium payments through the trust, but you can't take them back. And now it's outside of your estate. Therefore, there will be no estate tax on those assets when they transfer. And again, it's just simple little tricks, and it's dotting the I's, crossing the T's, and understanding the order of operations. Just like when you learn basic arithmetic and math in school, you've got to follow the order of operations. If you get that wrong, you can end up getting some double taxation or some big mistakes in estate planning.
This kind of planning is why you ought to avail yourself of the opportunity to get a complimentary report card. This is the type of thing we look at. 402-369-7777. No charge, no obligation. It's a total review of your financial situation. Looking for situations like this in which an ILIT, an irrevocable life insurance trust, might make sense for you. 402-369-7777 for the report card. 402-369-7777. Up next, Nebraska is among the 27 states fighting the new mortgage rules proposed by the president. We'll tell you why next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, here's the Fox Business headline: States revolt against Biden's quote-unquote disaster mortgage redistribution rule to subsidize risky loans. What's going on, David?
Well, you're basically penalizing people for doing the right thing. Again, how on earth did someone come up with this ideology to begin with? It's lunacy at best. All right. It's so we want to reward people for not paying their bills, and we're going to buy down their mortgage rate to try and incentivize them to buy a home they probably shouldn't or couldn't afford, right?
This is starting to sound like 2008.
Yeah, doesn't it? And
Yeah.
so, and furthermore, not only are we incentivizing that, so what we did from the 1996 Clinton signed law, where we made it much easier and we actually forced the government agencies to give loans to people that couldn't qualify otherwise,
Right.
which is how we ended up in that housing crisis after a decade of that, loosey-goosey money, so to speak, right? Now they're trying to go back to that type of policy when it was an absolute disaster, right? Of course, this is buying votes, so you're trying to reward bad. But not only this, Chip, not only are they now just incentivizing bad behavior, they're now punishing good behavior.
Well, because I'm wondering, where do the funds come to subsidize the risky ones?
So they want you to now pay a penalty of 1.75%, a fee on your mortgage. So if you want to go out and take a $500,000 mortgage, let's say you've got an 800 credit score, you've done everything right, and you go to get a new mortgage, they want to penalize you and charge you almost 2% on that mortgage, right? To penalizing you. So that's a $10,000 tax just to take out the mortgage, on top of all the other expenses, fees involved with closing and funding said
your
mortgage.
reward for being a responsible mortgage payer is we're going to gouge you for some more money to cover the people that we're worried about.
Soak the rich or the middle class in
Socialist
reality.
leveling
Yes.
is what it
This is
sounds
nonsense. And so we've already had 27 attorney generals basically step up to join, and I think more will join, and that's typically how it goes. You have about 30 states that kind of get involved in these things, typically more fiscally responsible states, by the way, right? But, states that are not fiscally responsible, this is great because they want the economic activity. They don't care about the cost because they just want to kick the can down the road and get through their next election cycle, and that's just the reality of things. But this is just crazy policy. There's zero reason for this to go forward, and I don't believe it's constitutional, and so I think ultimately it ends up getting reversed.
Well, and I'm looking at the story here. Here's one line out of the story. The controversial policy has been attacked by both Republicans and Democrats, including President Obama's former federal housing administrator. So it is drawing some bipartisan criticism. We'll keep an eye on that one for you. Hey, David, speaking of loans, here's a headline from Barron's. SoFi saw personal loans soar this quarter. Why that might not be a good thing. Is it too permissive? Is it what's going on here?
Okay, so this kind of is just from last story to this story, right? We're worried about getting people to borrow money that we don't think they can pay back, right? And this is what happened during the Great Housing Crisis.
This is more echoes of 2008.
And so, and we have the problem right now. And just so you know, SoFi, they make mortgages, they make personal loans, but they kind of made a name for themselves. They actually named the stadium where the Super Bowl was played out there in L.A., where now the Rams and the Chargers split. That's a gorgeous stadium, by the way. But so they kind of came to prominence with student loan refinancing. So what they did is they took your government loans, right? Most people would have like the Stafford loans, et cetera. They went out and got student loans way too much. And those interest rates were deferred while they were in school, so they didn't care, and they kept borrowing because the council, you can get some more money, Chip, no problem. And they come out of school with $400,000. I go to a church with a friend of mine, $480,000 in student loan debt. I'm like,
wow.
Did anyone tell you what you might make when you graduated and how long it would take? And nobody, as a fiduciary, I just think it's criminal that these kids are signing on for these loans with no explanation of how they're going to pay for it, what their career expectations are. And the sad thing is 1 in 7 people don't, only 1 in 7 people even work in the career field they go to school for, Chip. So that's really scary. You take on all this debt for what, right? But anyway, so SoFi, back to the story, but SoFi made a name for itself by refinancing that debt. So when your Stafford loan or something reset at 6.75, hey, we'll finance it when interest rates were lower at like 4.5%. So it seemed like a great deal. So you took the debt from the guaranteed debt of the government's problem and you put into a private loan, and now you got to pay it. Well, Now you got to come up with a payment every month. And now SoFi is starting to find out that, oh, wait a minute, people aren't making the payments on some of these loans. Imagine that. And so their finances are now going to be hurting because they've made these loans and they have a balance sheet full of stinky loans, right? And it's just, again, if you lend money to people that have no reasonable expectation or affordability to pay it back, what do you think is going to happen with the loans? They're going to go in delinquency, right?
Yeah.
And so they're just going to wait for the government to bail them out, of course, as part of the student loan package. And so, but again, bad news. This is ridiculous that, we're continuing to push this. Universities should have to guarantee the loans. If they think their product is so good and they want you to borrow money to go, why don't they guarantee the loan for you? And guarantee you job placement, et cetera, right? Wouldn't that make sense? I mean, if it's that, we have a billboard at our airport. I go in and out of Eppley a lot. I'll be flying out tomorrow. And we have that big sign. Hey, it's a 9-to-1 return on every dollar spent at Nebraska universities, right? They proudly talk. So guarantee the loans. You don't need the government if you get a 9-to-1 return, right? I mean, ROI 9-to-1 is good. I'll put money in that slot machine every day. I put $1 on top, pull the handle, and 9 comes out the bottom. How many times do you want to do that, Chip? I'll lather, rinse, repeat, right?
Yeah.
But,
Meanwhile, I noticed the story here in Barron says that as this news rolled out, SoFi stock dropped 12%.
Well, that's just it, is they can't keep this up. And this is another financial that is getting clobbered. And as we saw, I talked about earlier in the show, we saw the financials, the regional banks get slaughtered this week. Like I said, some of the banks were down over 30% just on Tuesday alone after Jamie Dimon said, hey, everything's okay. If you believe that, then you can believe that. But if you're concerned, if you think there's things that you might want to look at or at least take action so you have a proactive plan so your portfolio doesn't have to sit there and just take it, you might want to take advantage of the report card.
David, in the minutes we have left this week, I saw something at CNBC and I want to get your take on it. The headline is, after-tax 401k contributions can be a great opportunity for big savers. I wanted to know if you agree with that. And there was some discussion in the story about Roth conversions, which is a passion for you and for Retire Smart. In fact, we have copyrighted the strategic Roth integration as a term. So let me throw that at you in the few minutes we have left.
Well, the article also talks about how to make a mega Roth contribution to your 401k. And so I want to explain this to you. 401k was designed by mistake, right? It was in a part of the tax code, and that's why we call it 401k. It's the IRC code 401k, literally, where you could defer, and then we added the Roth component in 1997 to it. You can defer money into a retirement plan through a workplace vehicle, and usually these are 401ks. There's also 403bs, just so you know, okay? So for nonprofits and et cetera.
Well, and the heart of the Roth is pay the tax up front, and then when you take it out, 20, 30 years later, it's tax-free.
We offer a 401k here for our employees, and I put my money and I max fund the Roth 401k. Now, let me explain how this works. You can put $22,500 into your Roth 401k at work, and 88% of all 401ks in America now offer a Roth version. 88%, yet less than 10% of participants use it because they're not educated, Chip. That's just plain and simple. Financial literacy, as we talked about. But you can put $22,500. Once you turn 50, unfortunately, you and I have both hit that number. The gray hairs are real. We can then do another $7,500 in there, right? So you can do $30,000. So my wife works here as well. Guess what? We put $60,000 into an account that will never be taxed again. Now, here's the thing. There's what's called a 412 limit, and that limit is what sets how much you can put into other types of retirement accounts, max. It's $66,000 this year. If your 401k plan allows it, you can go past the $30,000 limit I talked about, Chip. You can actually do after-tax contributions into your account, all right? And if you leave it there, you can actually fund this up to $66,000 per person. Now, you have to have income to do this, all right? But those dollars will then roll once you're 59 and a half and retired into a Roth IRA, the after-tax contribution. So you can get an additional $36,000 in there, but your plan must allow for what's called a 412 limit. So I can tell you, we have clients that work at a publicly traded company here, Google, that does allow this, and we advise the clients to take advantage. They're high-income earners, and they can put $66,000 into an account that will never be able to be taxed again. That, in the current environment of government spending and higher tax rates coming, the tax storm, is of massive benefit for not only your wealth, but the beneficiaries that will ultimately inherit your wealth.
You know, we offer a complimentary tax planning guide, and you're certainly welcome to it. But to get this level of planning, that's what the report card is for. 402-369-7777. Now, don't forget about the estate planning workshops, Wednesday, May 10th, or Thursday, May 11th, 6:30 p.m., right here in the Midwest Learning Center. We need to know if you're coming. 402-369-7777 to register for the estate planning workshop. And then Shred Day, mark that down, the morning of May 20th, 9 to 11. 2 bankers' boxes full of stuff. We'll be glad to accommodate you. David, bring us home.
Hey, have a blessed and prosperous week. Hopefully you can enjoy some AC, as our building had to go without it for 2 days this week. So we'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.